Today, we're diving into what can only be described as a record-breaking run into the final stretch of 2025. From Wall Street to Tokyo, and even across Bitcoin and commodities, markets are pushing past previous highs like it's 2021 all over again. And yes, if you want to read the full article, you'll find a link to it in the description. It's packed with data and visuals for those who want to dig a little deeper, so I highly recommend checking it out. But for now, in today's video, we're going to unpack the wild ride that was Q3 and what could be waiting for us in Q4. So let's get into it. Risk was back on the menu this past quarter, and investors piled in. Artificial intelligence continued to dominate the narrative, but it wasn't the only story. Cyclicals, emerging markets, small caps, they all joined the party too. US and Japanese equities hit fresh highs. Gold blew through the $4,000 an ounce mark, and Bitcoin, it broke $126,000 per coin, reminding everyone it's still very much in the game. Was it all just a case of a weakening US dollar? Maybe, but let's take a closer look at the numbers and trends driving this rally. AI stocks, especially the speculative kind, surged across the US and China. Despite the whispers of an AI bubble, momentum kept winning out over caution. Emerging markets also surprised to the upside, riding the wave of a softer US dollar and signs of improvement in US-China relations. That thaw opened up risk appetite, and with it, opportunity. Small caps had a breakout moment too, especially in regions where growth hunting became the name of the game. And of course, the weak dollar lit a fire under gold, Bitcoin and commodity-heavy economies like Canada, Australia, South Africa and the UK. As for a regional recap, here's what happened and where. In the US, tech still led, but with a bit of nuance. The mega-cap giants weren't all marching in unison. Some soared, others paused. That divergence hints at more selective conviction amongst investors. Small caps actually edged out the giants, suggesting risk appetite is broadening out. Growth once again beat value, powered by AI-driven earnings and good old-fashioned speculation. And the communications sector, think Alphabet and Meta, delivered strong earnings thanks to resilient ad spend and their AI push. Energy, on the other hand, lagged behind as falling oil prices dragged the sector's earnings lower. Across the Atlantic, Europe slowed after a strong first half, while the UK held up thanks to rising metal prices, strong healthcare names, and a rate cut in August. Asia saw major movement. Japan reached new equity highs, as we mentioned, powered by AI exports and better corporate governance. Japanese REITs also stood out as well. Over in China, it delivered the strongest equity returns among major markets, supported by stimulus, a stabilizing economy, and that all-important trade progress with the US. India, however, lagged. Global investors favored China and Japan in the momentum chase. In emerging markets outside of Asia, improving sentiment, stronger commodities, and a weaker USD helped these markets outpace developed peers. Now let's talk about earnings. Despite all the doom and gloom forecasts earlier this year, corporate America proved it still has some muscle. A massive 82% of S&P 500 companies beat their earnings expectations. Nearly 60% even raised full-year guidance. Considering that the average percentage of S&P 500 companies that beat estimates is around 78% post-pandemic, it seems that analysts may be being conservative with their estimates. And sure, earnings growth is slowing, which is no surprise here, but it's still managing to outperform expectations. Two big tailwinds helped out here: AI-related spending and the weaker US dollar. Sectors like tech and communications thrived, with AI translating into real revenue in some cases. Healthcare used digital tech to boost efficiency and innovation. But energy, as we mentioned, stayed in the doldrums, and rate-sensitive sectors like real estate and utilities took a hit from higher financing costs. Interestingly, despite tech's ongoing rally, valuations aren't much higher than they were a year ago. So in many cases, earnings are simply keeping pace with price gains. Now let's talk about economic policy. Finally, there was a rate cut. After holding steady at 4.33% all year, the Fed finally pulled the trigger and cut rates in Q3. Markets are now betting on a full easing cycle, possibly 125 to 150 basis points over the next year. That's been enough to offset fears of a looming recession. But while the US is easing, the global picture is more complicated. Treasury yields are dropping stateside, but rising in Europe and the UK. It seems everyone's marching to a different policy drum. The US labour market, meanwhile, continues to soften, but not alarmingly so. Jobs growth is slowing, but unemployment is holding steady, which is giving the Fed room to breathe. Globally, we're seeing some positives too. Oil prices have cooled, the USD is weaker, as we mentioned, inflation appears stable, and for now, global trade tensions have somewhat eased. So let's talk about the outlook for Q4 of this year. Heading into the final quarter of the year, the mood is cautiously optimistic in the United States. The fundamentals look solid. Corporate earnings are still strong and AI spending continues to impress. That said, there are some caveats. Valuations, particularly in the AI-heavy US market, are starting to make some analysts nervous. And policy uncertainty, especially in the US, is a wild card that could swing sentiment quickly. Outside the US, however, markets are cheaper and looking attractive. But to be fair, global sentiment still dances to America's tune. Some key risks we believe are worth watching include US policy uncertainty, like tariffs, rates, inflation, and China's economy, which still casts a long shadow over emerging markets and commodity exporting nations. So what's the insight here? Well, diversification and quality are still your best defense. It's clear the AI cycle has legs. We said that a year ago, and the capex trend has not slowed down. Calling a market top is incredibly tough and arguably not worth the time. And more often than not, those who try miss out on gains. That's why holding a diversified portfolio of high-quality stocks is still your best bet. Why? Well, because earnings from AI's big names are starting to converge with the broader market. Those less loved sectors might just become your cushion when the next bout of volatility hits. And if the AI boom keeps running, great, your tech exposure benefits too. The same goes for international stocks, which are becoming increasingly sensitive to US policy and currency swings. The biggest risk right now is getting caught holding too many speculative plays. Quality stocks have a history of bouncing back, but speculative names, not so much. So as always, use Simply Wall Street's company reports to evaluate risk and reward potential, estimate conservative fair values, and rebalance your portfolio using our portfolio tool to ensure your exposure aligns with your goals and your future expectations. And that's where we'll wrap up this week's Market Insights. If you'd like to read the full article, you'll find the link in the description. As always, if you've got any feedback, we would love to hear it. With that being said, we'll be back next week with more Market Insights. But until then, invest well.